All right, well, I think we got to start off with Alphabet. Big upside move after earnings. A lot of people feel like this is re-accelerating the tech trade. However, there's still a lot of issues out here with tariff and trade, and these companies are certainly growth sensitive. What's your take on tech right now this morning?
Well, I think, again, as you said, there's sensitivity to the tariffs. I think for something like Alphabet or Meta, maybe not as impacted as, say, an NVIDIA and some of the other chip companies where it directly impacts their supply chain. But it is worth noting that while Google had great earnings and raised their dividend and had a fairly positive guidance, they did see some drop off in e-commerce. And then if you want to think big picture and you want to think AI and that trend that has really been the key driver of technology, still talking about ways in which they can monetize AI, still looking at potential cannibalization of their advertising business, which was a key driver of their earnings this past quarter. So, still question marks for sure.
All right, a lot of question marks. Another area I want to talk to you about are consumer staples. So consumer staples is actually the only sector that's negative week to date. We actually had a guest on earlier this week, Amy Wu Silverman from RBC, telling us that the options market was showing some warning signs when it comes to staples, and then actually they were expecting to see some guidance cuts. Again, week to date, looking at staples down 1%. We just hit this a short time ago. Church & Dwight and Pepsi having their worst week since 2023. Kimberly-Clark and Procter & Gamble having their worst week since 2022. What do you make of this so-called defensive trade turning so bad?
Well, I mean, it makes sense if you think about the way that the momentum of the market has swung in the last week. It's an indicator that potentially this concern about recession and potential economic downturn might be a little too aggressive in that sense. So I would say that I wouldn't take this as much of a point right now, because if we are going to see any slowdown economically from tariffs, where consumers tend to cut back is not in staples. And those tend to be the types of companies and the types of consumer goods that people will not cut back on. However, something like a Pepsi, if you think about, there's some unusual economic indicators. There's something called like the snack indicator, where during tough times, people tend to cut back on their snacks and in favor of other types of more important aspects of nutrition. So, there's something to think about there. But I would just say that this is a reflection of the momentum swing we've seen in the market. The outlook, of course, is concerning because you want to know kind of how people are thinking about it. And tariffs do impact staples.
While we're talking about the broader market and sentiment right now, JP Morgan came out with a note. Dubravko Latko's come out with a note. I'm going to just read part of it to you. He says, in part, the sentiment is very bearish, especially within the macro community. Most are disregarding the latest trade developments, in part due to what he calls Trump exhaustion. We observe that many prefer to stay in cash and maintain lower leverage in their books. What does that mean in the market if people right now are staying in cash, whether that's money markets or short-term bonds, whichever way you want to describe cash? What does it mean that all that money's on the sideline? Is that actually good for the equity market longer term because there's a potential for it to pop back in the market and kind of push things higher? Or is it a concerning sign of bearishness that people want to get out?
Well, a couple of things you look for as a potential trigger for a change in sentiment is the fact that there's sort of a contrarian sentiment, right? We've seen a lot of retail buying the dip because there's like an entire generation that has learned to buy the dip because more times than not, the market has turned it around pretty quickly. So you kind of want to see retail money on the sidelines as a contrarian indicator. And as you pointed out, that actually can be really good way to drive the markets higher in a really quick way in the future. You kind of want to see this as a way of potentially indicating a bottom. But at the same time, I think one of the things you did talk about was this idea of Trump exhaustion. I think that's really the concern for investors as to how long somebody might stay in cash. We've seen such changes in policy, especially as it relates to the tariffs. And it looks like things are calming down. But I think because of the whipsawing effect that we've seen and just the announcements of policy changes, investors are going to be cautious to jump in too quickly. So I think we might see cash stay on the sideline a little bit longer, which for me means that maybe we have not seen enough change to indicate that any market gains that we're seeing right now are sustainable.